You are never supposed to understand how this works. The people who built this system didn't want confusion. They wanted clarity for themselves and noise for everyone else. Every terminal, every trading floor, every closed-door meeting runs on rules that were written before you were born. You follow the market. The market follows something else entirely. It is 4:47 a.m. on a Tuesday, and the lights inside a Lower Manhattan building are already on. A man in a grey suit walks past a row of glowing screens, and each one updates the moment he enters the room. He doesn't sit. He reads 3 numbers on the far monitor, and a junior analyst immediately picks up a phone. No one explains what just happened. By 5:15 a.m., 3 institutional orders have moved. Positions shift across 4 exchanges before the city's coffee shops open their doors. The people making those decisions are not reacting to the news you will read this morning. They are reacting to information that will become your news tomorrow. This is not a conspiracy. It is a structure. Wall Street is not a place where smart people compete on equal terms. It is a layered system where access, speed, and information flow in one direction, and that direction is never toward you. The architecture was not designed by accident. It was built deliberately, refined over decades, and protected by the very institutions that claim to regulate it. You see the surface. You see earnings reports, index numbers, and market summaries delivered through a screen. What you don't see is the infrastructure underneath, the relationships, the timing advantages, the capital pipelines that determine outcomes before the opening bell rings. A trader on the 43rd floor leans back, and the room around him continues moving without him. He has already made his decision. The market will catch up in about 6 hours. By then, the opportunity will be gone, the position will be closed, and the cycle will reset for tomorrow. You were watching the wrong thing the entire time. You open an app on your phone, and a colourful interface loads with green arrows pointing upward. The design is clean, frictionless, and built to make you feel like a participant. You buy 3 shares of a company you read about, and a confetti animation falls across your screen as the order confirms. What the animation does not show is where your order went next. Your trade leaves the app and enters a system you never see. It routes through a market maker, a firm that sits between you and the actual exchange, processing millions of orders like yours every hour. That firm earns a fraction of a cent on your transaction, multiplied across every retail investor using every consumer trading app in the country. They are not charging you a commission. They are reading your behavior and pricing it accordingly. You close the app and feel like an investor. The market maker closes the day up $14 million. A portfolio manager walks into a morning briefing, and 12 analysts stand when she enters the room. She manages $4.2 billion across 3 funds, and her decisions move markets in ways your 3 shares never will. She doesn't use a consumer app. She has direct market access, co-located servers, and relationships with prime brokers who call her before information becomes public. Her team has already run overnight models before she sat down. She reviews a single page and circles one number with a pen. By 9:31 a.m., 1 minute after the opening bell, her fund has already executed a position that retail investors won't understand until the quarterly report surfaces 3 months from now. The trade was not illegal. It was structural, built on access, speed, and a layer of infrastructure that requires 9 figures just to enter. She caps her pen, and the room begins moving again. Deep inside a glass tower, A prime brokerage desk handles the accounts of hedge funds, managing capital most people will never see in a lifetime. The prime broker does not trade. The prime broker enables. They provide leverage, securities lending, and custodial services that allow funds to operate at a scale that bends the market itself. A hedge fund borrows shares from the prime broker, sells them short, and profits when the price falls. A mechanism that can accelerate the very decline it is betting on. The prime broker earns fees on both sides of the transaction. A risk officer reviews the exposure report, and a single fund's position fills 4 printed pages. The fund is leveraged 6-1. The prime broker holds the collateral. If a trade fails, the prime broker recovers first, before the fund, before the investors inside it, before any downstream institution watching the same stock collapse in real time. The system was designed with this sequence in mind. The risk officer signs the report and slides it across the desk without looking up. Not every trade happens where you think it does. A significant portion of daily trading volume never touches a public exchange. It moves through dark pools, private trading venues operated by the largest banks, where institutional orders execute away from public visibility. The price you see on your screen is real, but the volume behind it is not the complete picture. Large blocks of shares change hands in these private venues, and the public market adjusts afterward, not before. A compliance officer walks past a server room, and the hum of the machines fills the corridor behind her. She is not monitoring for manipulation. She is monitoring for reporting thresholds, the specific size at which a trade must become visible to regulators. Trades are structured to move beneath that threshold, broken into smaller pieces that individually require no disclosure. The outcome is the same. The paper trail looks different. She closes the server room door, and the corridor goes quiet. A congressional hearing room fills with cameras, and a Wall Street executive adjusts his microphone. The questions are firm. His answers are longer. He uses terms that are accurate, complete, and entirely designed to require 3 additional questions before anything resembling clarity emerges. The committee members take notes. The testimony runs 4 hours. By the time it ends, the regulatory framework under discussion has not changed. The proposed rule has been delayed 18 months for further comment, and the executive's firm has already adjusted its compliance structure to absorb whatever version of the rule eventually passes. He shakes hands on the way out, and 2 lobbyists fall into step beside him. The system does not resist regulation through defiance. It absorbs regulation through participation, through comment periods, through advisory committees, through the steady movement of people between regulatory agencies and the institutions they once oversaw. The revolving door does not spin dramatically. It rotates slowly, quietly, and with complete legal permission. A junior regulator submits her resume to a bank she spent 3 years investigating. She receives a call back within 48 hours. She accepts the position, and her old desk is filled by someone new who will spend the next 3 years learning the same system from the outside. The cycle does not pause. It simply continues. Pull back from every level you just saw, and a single pattern emerges across all of them. The retail investor loses time. The institutional desk gains it. The prime broker collects fees from both directions. The dark pool moves volume away from visibility. The regulator becomes the regulated. Every layer feeds the next, and the architecture underneath all of it was not assembled by accident. It was engineered over a century of deliberate construction, crisis by crisis, bailout by bailout, rule by rule. A historian opens an archive box in a Washington library, and the documents inside date back to 1913. That year, a small group of bankers and legislators drafted the framework that would become the Federal Reserve, a meeting held in secret on a Georgia island, attended by men representing roughly 1/4 of the world's total wealth at the time. The meeting was not disclosed for 20 years. The institution it produced still sets the interest rates that determine the cost of every mortgage, every business loan, and every government borrowing in the United States today. The system you navigate was designed in a room you were never told about. A Federal Reserve official steps to a podium, and every screen on every trading floor in the country updates simultaneously. He speaks for 11 minutes. The word gradual appears twice, and an algorithm flags it both times, executing a preloaded position before the sentence finishes. By the time a financial journalist types the headline, the trade is already closed. The profit was not made on what he said. It was made on the speed at which a machine processed what he said before any human could react. The information was public. The infrastructure to act on it in microseconds was not. This is the reveal that changes how you see every number you will ever read on a financial screen. The market is not a neutral scoreboard tracking the value of companies. It is an infrastructure, built, maintained, and continuously refined by the same institutions that benefit most from its current configuration. The rules exist. The rules are also written by participants, and the distance between those two facts is where the system lives. A janitor pushes a cart through an empty trading floor at midnight, and the screens above him continue updating in the dark. No one is watching them. The algorithms are still running. Positions are still moving across Asian markets. Orders are queuing for the 9:30 opening bell 7 hours away. The floor that looks dormant is not dormant. It is operating at full capacity without a single human decision being made. The janitor empties a trash bin beneath a monitor, showing a number that will determine whether a pension fund in Ohio can meet its obligations next quarter. He does not know this. He was never supposed to. The system does not require your understanding to function. It requires only your participation, your deposits, your retirement contributions, your index fund purchases, your consumer spending patterns, all of it feeding capital upward through layers you now recognize, but were never designed to see. A senior partner at a private equity firm closes a laptop, and the city outside his window is still lit at 11 p.m. He has just signed off on an acquisition that will restructure a company employing 4,000 people. The restructuring will improve the fund's return by 2 percentage points. The decision took 9 minutes. The consequences will take 3 years to fully surface, distributed across communities, families, and local economies that will never appear in the fund's performance report. He stands, puts on his coat, and the office empties behind him. The building stays lit. The positions stay open. The system moves forward without pause, without apology, and without the need for anyone left in the room. There is a moment, after you see the system clearly, where something shifts inside you. It is not anger, not immediately. It is something quieter, more disorienting. You realize that the confusion you felt was not a personal failure. It was a structural feature. The complexity was not accidental. The distance between what you were shown and what was actually happening was maintained with precision, updated regularly, and protected by the institutions whose primary obligation was to close it. A professor erases a formula from a chalkboard, and 30 students stop writing at the same time. She draws a single vertical line instead. On the left side, she writes, "What markets are supposed to do." On the right side, she writes, "What markets actually do." The space between those two columns is not filled with corruption in the dramatic sense, no single villain, no single moment of betrayal. It is filled with incentive, with access, with a slow accumulation of advantages so normalized that the people operating inside them stopped noticing they existed. She caps the marker, and the room stays silent for longer than usual. This is the uncomfortable truth at the center of the system. The people inside it are not, for the most part, breaking rules. They are operating within a framework that was shaped by people who benefited from shaping it, enforced by people who will later be employed by the institutions they enforced it against, and explained to the public through a financial media infrastructure that depends on the same institutions for access, advertising, and information. A financial journalist sits across from a bank executive in a glass-walled conference room, and a publicist sits in the corner taking notes. The journalist asks 3 sharp questions. The executive answers 2 of them. The publicist writes something on a notepad and slides it across the table. The executive glances down and redirects the conversation toward quarterly earnings. The journalist does not push back, not because she lacks the instinct, but because losing access to this building means losing the story entirely. The interview ends. The profile runs. The executive's name appears in the headline, and his firm's position in the market strengthens slightly by association. The camera crew packs up, and the publicist holds the door. This is not censorship. It is gravity. The system pulls everything toward its center: journalists, regulators, academics, politicians. Not through force, but through the simple distribution of access, funding, and career momentum. People do not need to be told what not to say. They learn, over time, what gets them back in the room and what doesn't. A young analyst sits alone at his desk at 2 a.m., and the floor around him is empty. He has spent 6 months building a model that reveals a structural inefficiency in how a particular class of derivatives is priced, an inefficiency that, if published, would embarrass 3 of the firm's largest clients. His managing director reviewed it that afternoon, said the work was exceptional, and told him to file it internally. Not publish it. Not present it at the conference he had been invited to speak at. File it. The analyst closes the model, saves it to a folder no one will open, and begins working on the next assignment. He will be promoted in 4 months. He is learning the system now, not in a classroom, in a filing decision at 2 a.m. that no one witnessed and no one will discuss. The philosopher Thorstein Veblen wrote that institutions are the settled habits of thought common to the generality of men. Wall Street is not an exception to this. It is its most refined expression, a place where the habits of thought were settled long ago, formalized into infrastructure, and handed forward to each new generation not as ideology, but as simply the way things work. A new analyst walks onto the trading floor on his first morning, and the room absorbs him without breaking stride. He adjusts his badge, straightens his jacket, and moves toward the desk they assigned him. Within 6 weeks, he will stop questioning the rhythm of the floor. Within 6 months, he will defend it to people who question it from outside. Within 3 years, he will train the next analyst arriving at the same door with the same questions he once had. The system does not convert people through argument. It converts them through immersion, until the structure feels less like a choice and more like the shape of reality itself. It is 4:47 a.m. on a Tuesday, and the lights inside a Lower Manhattan building are already on. You know this building now. You know the man in the grey suit who walks past the glowing screens, and you know what the number on the far monitor means, and you know why the junior analyst picks up the phone before anyone speaks. Nothing in the room has changed. The terminals are the same. The sequence is the same. The only thing different is the person watching it. You stand outside on the pavement, and the city moves around you without acknowledgement. The system does not know you understand it. It does not need to. It will continue processing orders, routing capital, absorbing regulation, and cycling personnel through its revolving doors at the same pace it maintained before you watch this video, and at the same pace it will maintain after. Understanding a system and changing a system are two entirely different distances. A young woman steps out of a subway exit 2 blocks from the exchange, and her bag carries a resume and a finance textbook. She is 23. She has studied hard, prepared carefully, and believes, with complete sincerity, that she is about to enter a meritocracy. She is not wrong about her ability. She is not wrong about her preparation. She is simply unaware of the architecture she is walking into. The layers, the incentives, the filing decisions at 2 a.m., the revolving doors, the dark pools, the algorithms executing in microseconds. The room in Georgia in 1913 that no one mentioned in any of her courses. She straightens her jacket at the building entrance, and the doors open automatically. The floor absorbs her the same way it absorbed everyone before her, without resistance, without explanation, without a single person stopping to describe the shape of the thing she just entered. Within 6 weeks she will stop questioning the rhythm. The system does not announce itself. It simply continues, consistent and patient, waiting for participation the way it has always waited. Not by demanding it, but by making every alternative feel less structured, less legitimate, less real. The man in the grey suit passes her in the lobby without looking up. He was her once. He asked the same questions in the same order and arrived at the same filing decision and received the same promotion and trained the next analyst with the same quiet confidence of someone who has stopped remembering that he ever stood where she is standing now. The system converted him not in a single moment, but across 1,000 small ones, each one reasonable, each one professionally sound, each one pulling him 1 degree further from the outside perspective he arrived with. She walks toward the elevator, and the lobby doors close behind her. Outside, the city continues. A retail investor checks his phone app and watches a green arrow point upward. A pension fund manager in Ohio reviews a quarterly statement that is 2 points below projection. A regulator files a comment period extension on a rule that was proposed 14 months ago. A lobbyist boards a 6 a.m. flight to Washington with a briefing document and 3 scheduled meetings before noon. A janitor finishes his shift on the empty trading floor and rides the service elevator down as the first analysts begin arriving through the front entrance. The screens update. The algorithms run. The opening bell is 4 hours and 13 minutes away. You were never supposed to understand how this works. Now you do. And the system is already moving toward the next person who doesn't.